India's benchmark stock index, Nifty, stabilized after falling to a multi-month low as risk-on sentiment improved after some prominent BJP-savvy high-profile lawyers debunked the US DOJ indictment against Adani Group involved in the bribing scam of various government officials for solar power projects in various Indian states. Before that, India's Nifty crumbled over 10% from a recent lifetime high on subdued corporate earnings growth, expensive valuation, concern about the Trump trade war, elevated and sticky headline inflation, and hawkish RBI, and the never-ending Adani saga also dragged the market. India's central bank, the RBI, is still hesitant to cut rates, despite high unemployment in India, and lower core inflation for the last few quarters. India's unemployment rate has remained elevated above 8% on average for at least the last 2 decades, and jumped above 10% even in October, while core inflation has hovered well below 4.0% targets for almost the last 10 months. Various high-frequency indicators are also indicating an imminent economic slowdown, despite the RBI Modi admin stance of all is good, Sab Changasi high. Nifty made a low around 23,463.15 on the 21st of November, and subsequently recovered on BJP NDA's much better than expected win in the Maharashtra election, which may help to consolidate PM Modi's control over Indian politics and policies. The market got some boost on hypes of blockbuster economic reforms in India by strong Modi 3.0. But that optimism soon faded as it became clear that the recent unexpected election win in Haryana and Maharashtra by BJP or NDA without active contribution by PM Modi. BJP was able to win the Maharashtra election without any Modi wave, thanks to active participation by RSS in election management at ground levels with some social engineering. Also, unprecedented helicopter money, that is cash for vote policy by BJP and NDA, helped to win these state elections after the shocking performance in the recent June 24 general election. Thus, BJP and NDA may also win the next big election in Bihar, and even in Delhi without any Modi wave. Therefore, autocrat Modi may not be now inconvincible for BJP and RSS to win elections in various states. But at national levels, the BJP or RSS still may not be able to project another PM face in lieu of Modi, who can ensure at least 200+ seats in the general election. Thus, Modi 3.0 may also be extended full tenure to May 29, but PM Modi may also take self-retirement by December 25 on a 75-year voluntary retirement age policy in BJP after a good performance in various state elections, post the debacle in the June 24 general election. This will be like Sachin Tendulkar taking retirement from active cricket after hitting a century in the last game. Like Tendulkar, Modi is also a great leader in the games of complex politics in India. In any way, irrespective of Modi or no Modi, the Indian political landscape is now fragmented among various small, big, regional parties across India. The resultant political partisan is causing policy paralysis across India. Also, a weak Modi 3.0 in the federal government and lack of an absolute majority of BJP in 2 houses of the parliament are causing a policy paralysis-like scenario at the federal level. Even smaller regional allies of the BJP and their leaders are now not in the mood to obey weak Modi amid the diminishing Modi wave and autocratic hold. This was unthinkable before February 24, when India's political funding scam through electoral bonds was exposed, which shows BJP Modi admin is also a part and parcel of India's legacy issue of political corruption. In brief, Modi and co. is now too busy with politics rather than economics and policies. Although initially PM Modi was quite liberal and flexible during his early days. But Modi changed his administrative approach after the failure of demonetization and the hurried implementation of a faulty GST regime, followed by unplanned COVID lockdown across the country, causing economic disruptions in each case. PM Modi then virtually centralized all major and even minor policy issues within PMO, which inordinately delayed the decision-making process and affected the economy. Moreover, India's Dalal Street was also under pressure from the never-ending Adani scandal saga. Although the Adani group of stocks has negligible weightage in Nifty compared to RIL, HDFC banks and other blue chips, the fact that various scam allegations against the BJP-savvy Adani group have also raised corporate governance culture in India. Also, the quality of India's political, judicial and regulatory governance is questionable in a country like India, where corruption is rampant and a way of life. But investor sentiment also received a boost from the debunking of the U.S. Department of Justice indictment against the Adani Group by some high-profile Indian lawyers close to the Adani Group and also the BJP. This stock market's upward movement in the last few days was also fueled by investor optimism regarding potential rate cuts by the Reserve Bank of India. The anticipation of a rate cut comes in the wake of a terrible GDP report for the second quarter of fiscal year 2025. This development eased concerns that had previously weighed on the market. The Nifty's recent surge follows a period of significant decline. The index had tumbled over 10% from its recent lifetime high. This downturn was attributed to several factors, including subdued corporate earnings growth and bubble valuations. At around 24500 Nifty and 877 TTM EPS for Q2 FY25, the current TTM Nifty PE is around 28, still far above bullish valuation zone 25. The average fair PE is around 22, 20 against average Nifty EPS growth of 12%. Also, concerns about the ongoing Trump trade war 2.0 and its potential impact on the global and Indian economy contributed to the decline. Additionally, elevated and persistent headline inflation and other macro headwinds coupled with a hawkish stance from the RBI dampened investor sentiment. The recent GDP report for the second quarter of fiscal year 2025 revealed a slowdown in economic growth, raising concerns about India's economic outlook. The report indicated that GDP growth had slowed to 5.4%, the lowest rate observed in the past 7 quarters. This figure fell short of market expectations and signaled a potential economic slowdown or even an all-out recession. This slowdown has sparked debate among economists and policymakers about the most effective measures to stimulate growth and restore confidence in the Indian economy. India's economy is currently grappling with a challenging combination of slowing growth, rising unemployment, and elevated inflation. This confluence of factors has raised concerns about the country entering a period of stagflation. The latest GDP figures showing growth slowing to 5.4% in the second quarter of fiscal year 2025 have further amplified these concerns. The slowdown in economic growth can be attributed to a number of factors, both domestic and global, also structural as well as exceptional. One significant concern is the persistent level of high unemployment and underemployment in the country. The average headline unemployment rate hovers around 8%, indicating a lack of job creation and a surplus of labor supply against subdued labor demand. This situation is particularly worrisome given India's young and rapidly growing population. The so-called demographic dividend may be now turning into a demographic nightmare. Addressing unemployment is crucial for ensuring social stability and unlocking the country's demographic dividend. Adding to the economic challenges is the issue of inflation. There has been virtually no price stability in India for at least the last 2 decades due to unstable and sliding currency or INR and constrained supply capacity of the economy, compared to elevated natural demand from a rising huge population of almost 1.45 billion. India may be 5th largest economy in the world, but remains at 140th in terms of GDP capita. While core CPI has remained relatively stable at 3.4% in 2024, headline inflation has remained elevated above 5%, and food, fuel, and energy inflation around 10% on average for the last 20 years. This means that the general cost of living has jumped over 100 to 200% in India in the last 20 years. This also suggests that India has virtually no price stability, and without the price stability, no economy can function properly. The elevated inflation rate erodes purchasing power and disproportionately affects low-income households. The RBI's Monetary Policy Committee is currently facing a difficult decision and policy dilemma regarding high borrowing costs in India for too long, affecting economic activities without bringing down the headline inflation to a 4% target on a sustainable basis. If RBI targets 4% CPI, then the real GDP growth target should be also a minimum of 8%, if not 10%, as we have seen in China during 1990 to 2000 reform and transformation. India may be now heading for a hard landing rather than a soft one. Thus, investors, traders, and also policymakers are now tightening seatbelts for a potential crash landing of the Indian economy. Elevated and sticky inflation, higher borrowing costs, and abnormally high indirect taxes and tariffs are legacy issues for India, affecting consumption and production and the overall economy. However, high inflation in India is a function of the constrained supply capacity of the economy, rather than excess demand from consumers requiring monetary action. India now needs proper fiscal policy intervention and deficit spending to increase the supply capacity of the economy, along with RBI rate cuts, to ease higher borrowing costs. For example, as we have seen in China during economic slowdown times, India may also build high-speed railway infrastructure across the country for its indigenous semi-high-speed trains like Vande Bharat. The RBI is tasked with maintaining price stability while supporting economic growth and financial stability. But as a central bank, RBI should be also entrusted with employment stability, and thus the government should officially give RBI a dual mandate of maintaining maximum employment and price stability like the US Fed. The recent slowdown in India's GDP growth and the potential threat of stagflation have led some analysts to anticipate a rate cut in the upcoming RBI MPC meeting. RBI may cut 50 BPs on the 6th of November policy meeting based on core CPI to stay ahead of the curve, rather than waiting for February 25, as the trend indicates only 5% real GDP growth in FY25, against RBI's estimate of around 7%. India's political landscape is currently characterized by a sense of uncertainty and a lack of clear direction. The ruling BJP or NDA-led federal government, under the leadership of Prime Minister Narendra Modi, is under immense pressure for its handling of the economy in recent times, as Modi admin is too busy with politics rather than economics. The Modi government's too much focus on state elections and political maneuvering has been perceived as a distraction from addressing pressing economic challenges. The recent unexpected victory of the BJP NDA in the Maharashtra and Haryana state elections has provided a temporary boost to PM Modi's political capital. However, this victory has done little to alleviate concerns about the government's ability to implement bold economic reforms. Too much reliance on social engineering and election management by India's main political parties like BJP and Congress has raised concerns about the future direction of economic policy. Indian politicians are too busy with caste surveys rather than employment, and are more concerned about the constitution, the question of democracy and autocracy rather than the economy. Neither the BJP nor the Congress government is interested in the regular publication of basic economic data, like the employment situation of the country, core CPI inflation, and retail sales in a credible format by official government and also private agencies. There may be political compulsion, but at the end of the day, policymakers also need authentic, basic economic data to steer the economy. There is no concrete plan or debate by either the BJP or Congress for the Indian economy and how to provide quality and inclusive maximum employment, especially in the private sector, ensuring price stability. The market's reaction to recent political and corporate events has been mixed. While the Nifty index initially surged following the BJP and NDA's impressive win in the Maharashtra state election, the rally proved to be short-lived. The ongoing Adani Group controversy, involving allegations of bribery, fraud, and misconduct, has cast a shadow over the market and raised concerns about corporate governance and crony capitalism in India. The Adani Group controversy has highlighted the importance of strong corporate and political governance and transparency in emerging markets like India. The allegations against the Modi-savvy conglomerate, if proven true, could have significant ramifications for investor confidence and the ease of doing business in the country. Addressing India's economic challenges and ensuring sustainable growth will require a multi-pronged approach. Bold policy reforms are needed to boost investment, create jobs, and improve productivity. Along with lower borrowing costs, the Indian government should also prioritize reforms in key areas such as industrial infra, efficient logistics, affordable energy costs, fair labor laws, land acquisition, taxation, and political funding. The government should ensure a respectable minimum wage policy in the private sector to reduce inequality and K-shaped economic growth. These reforms are crucial for attracting foreign and also domestic investment and fostering a more competitive business environment and level playing grounds. India's FDI and private capex continues to be subdued, affecting core GDP, that is private consumption and private capex. Private capex needs lower borrowing costs by at least around 5%, not 10%, and also ease of doing business in India. Government capex and consumption, that is deficit spending, is always secondary, as any government can print money even after collecting an abnormally high proportion of indirect taxes and tariffs. More investment in infrastructure is another critical area that requires attention. India needs to invest heavily in both traditional infrastructure, such as roads, railways, and ports, as well as in social infrastructure including education, healthcare, and sanitation. Adequate infrastructure is essential for supporting economic growth and improving the quality of life for India's citizens. Innovation and technological advancement are key drivers of economic growth in the 21st century. India needs to foster a culture of innovation and encourage investment in research and development. The government should create policies that support startups and incentivize private sector investment in emerging technologies. A balanced fiscal policy is crucial for maintaining macroeconomic stability and promoting sustainable growth. The government should strive to reduce its elevated borrowing costs while also ensuring adequate spending on essential public services, minimizing dole money, electoral politics, and political corruption. India's political funding system is also causing higher public debt without creating the productive capacity of the economy, leading to currency devaluation and never-ending inflation. No businessman will fund significant political funding from his own pocket without any vested interest. Reforming political funding, streamlining tax incentives, and reducing indirect taxes can help lower the cost of living and boost discretionary consumer spending. Finally, strengthening institutional autonomy is vital for creating a level playing field and ensuring the rule of law. Independent institutions such as the judiciary, central bank, regulatory bodies like CBI and election commission, and also independent media are essential for a vibrant democracy and a healthy economy. The Indian government of the day should respect the independence of these institutions and refrain from any attempts to undermine their autonomy. Eventually, India needs to invest much more in innovation to improve the productive capacity of the economy, which is the ultimate. When an economy keeps growing above its productivity growth levels, it will cause overheating and elevated sticky inflation. Also, when average wage growth stays persistently above labor productivity growth, it will cause a wage inflation spiral. For the Indian economy, subdued productivity is a legacy issue, mostly for public sectors and even in some private sectors. Hopefully, looking ahead, India's trained professional economists and policymakers will be able to address this basic issue of subdued productivity without being too obsessed with GDP figures and other political narratives, irrespective of the political boss of the day or even any Viswa guru.